Identify optimum risk-return combinations. To determine optimal risk-return combinations using Markowitz principles, you need to analyze the efficient frontier, which is a graphical representation of all possible portfolio combinations where each point on the curve represents a portfolio with the highest potential return for a given level of risk. The optimal portfolio for an investor lies on this frontier and depends on their individual risk tolerance, with higher risk-tolerant investors choosing portfolios on the right side of the curve, and more risk-averse investors selecting those on the left. A few of the assumptions of Markowitz modern portfolio theory include rational investors. Investors are rational and make decisions based on logical analysis to minimize risk. Equal access to information. All investors have equal access to the same financial data and other information. Homogeneous expectations. All investors have the same expectations and make the same choices in a given situation. Efficient markets. Markets are efficient and absorb information quickly and perfectly. Single investors. Single investors are not large enough to influence market prices. Risk-free borrowing. That's the assumption that unlimited amounts of capital can be borrowed at a risk-free rate, and the correlation of returns. Investors should measure the correlation coefficients between the returns of various assets.